First, RealPage, Jay Parsons put out an interesting report that I think contradicted some of the kind of the anecdotes and some of the things that we were thinking about on previous shows. So that's why we wanted to talk about it. I don't think it necessarily says that we were wrong, but I think it gives us a little bit more insight and I think maybe a better way to kind of look at it.
I was definitely persuaded. We've read and we've even said a lot about how high mortgage rates are maybe going to boost the apartment market because they'll discourage renters. But there was never really any hard data behind it. So I really appreciated seeing this information from Jay and put a really good, realistic, and pragmatic perspective on it. And likewise, I remember a couple of years ago when home prices really started to surge, we were saying that high demand for single-family homes does not mean that there's low demand for apartments, and we saw that really come to pass. Demand for houses increased just as demand for apartments did. So there's this connection between housing in general among the different kinds of housing. When it goes up, and everywhere it does.
Yeah.
And so to think that there's going to be a dramatic change from this from higher mortgage rates that will sustain apartment demand is maybe a little bit of wishful thinking. It is an interesting story, and I still think it has some legs, but maybe not as much.
I think Jay's point is that it's much more on the margins. It's not really a main driver, and there's a lot more important drivers to focus on. And with household formation being kind of that key driver of if there's declining household formation, people aren't moving out, roommates aren't kind of decoupling and moving out into separate houses or apartments. People are, if anything, moving in together with negative household formation, and that's a much bigger driver to pay attention to. That moves again the for sale single family home market as well as the apartment market itself. And again, it's the same thing in the pandemic. I mean, with the stories of everyone's buying homes, that didn't people weren't leasing apartments. In fact, demand for apartments was skyrocketing as well. The other big piece that he gets at, and I think that it can't be underlined enough, is that sentiment. The consumer sentiment and how people are feeling about the economy, how they're feeling about their own personal financial situation in the future. Not necessarily about like how their financial situation is today. They may be making a good income, they've got a job, all is good, but they're concerned about the future. And it's going to make them think twice before making a large decision like signing a lease or buying a home.
We've talked a little bit about low home buying sentiment, and it's hard for me to wrap my head around because I think that really what is easy for me to track is like what the actual actions are. But I think that right now, sentiment about the economy moving home buying decisions is maybe a little bit easier for me to understand than sentiment about home buying itself. And I also wanted to like a similar story that we tracked last year or the year before really was this narrative. So now there's this narrative of mortgage rates. They're going to reduce home buying and people stay renters. A couple of years ago, there was that story of people moving into smaller metros with a lower cost of living because of remote working. That didn't really come to pass, but it did come to pass a little bit. And I wonder if this is going to be the same story. So people maybe didn't wholesale move out of big cities into small cities, but places like New York and San Francisco, they really did move out somewhat.
It did happen. I mean, Boise or markets like Asheville or Chattanooga, markets like that. I mean, they did relatively well over a long-term basis. I know there's some turbulence now with some mean reversion. But I think overall on a bigger picture, less of a major driver than some of the bigger household formation and
what interests me about that trend as well as this trend in mortgage rates, it's the same thing as this. Maybe it's not a huge dramatic trend that's really noticeable, but even if it's just a marginal mild trend over the long term, that consistency I think is incredibly interesting.
I think so.
Mostly because first of all, I'm skeptical of rapid trends in the housing market in general because last time was a pandemic or
it's so much flash and
but I'm also interested in the long-term potential of this trend with mortgage rates because even if it changes just a small sliver on the edges for lifelong renters, even if it changes just as a little bit of people into lifelong renters, that's a big deal. We're talking about going against the grain of like a centuries-old conception of home ownership and American identity, and changing people's minds on that even a little bit is going to be extremely significant.
Well, it's, the millennials and Gen Zs that are going to be making that decision. I mean, that's the bulk of the renters, as we're going to see in one of these surveys later on. But just to test it, I want to pull up a chart, Matt, because looking at, comparing household formation and interest rates, and specifically mortgage rates, is there anything, what is that correlation?
Yeah.
And so let's look at a chart of household estimates. So this is essentially how many households, going up and down is going up is increase of household formation, and the inverse would be decline. And then also looking at the average 30-year fixed rate mortgage. And what we found interesting is we saw this big jump in household formation, kind of basically, almost immediately at the start of the pandemic and the recession back in 2020. And at the same time, interest rates were steadily declining. But they didn't really bottom out until, really, kind of January 2021. Mm-hmm. And then as soon as the discussion of interest rates rising started, they didn't rise yet. And they ticked up, mortgage rates ticked up just slightly, but it was a sharp peak.
And they were no longer going down.
But they were at the same rates they were just a couple months ago.
Yeah.
But then look at how, I'm speculating that this is 100% driven by, or mostly driven by, sentiment rather than the actual price. It's people assuming and being concerned that their mortgage rate was going to be higher, so people just left the market, and we saw household formation or households start to dip dramatically. It's almost like a sine wave here of the incredible demand at the beginning, and then change in interest rates right here in basically February and March, and then just a huge trough. And then it's popped back up as interest rates were declining, and then they've increased once again, and it's sort of leveled off. But this is much more about sentiment rather than actual I can't afford something. Although there are people 100%. It's not an anecdote because we've seen the data to support this.
Yeah.
And that we looked at last week. There are a lot of Americans who could have afforded a home. Mm-hmm. Maybe they didn't want to buy one. Maybe they did. There's a lot less of those that can afford a home now. And there is a lot of evidence to support that. But to Jay Parsons' point, household formation, positive or negative, and that sentiment is still a much stronger factor. And it doesn't matter if people can't afford a home.
Yeah.
They may be moving in with a roommate or moving in with their parents. You're going to see a decline in household formation. It's a much more, a stronger demand driver than cannibalizing from the single-family home market.
Yeah. And another thing about household formation is it does seem to, one of the predictive abilities, if you're going to try to predict, is what was happening a year ago or so. Because you see that huge spike in household formation immediately following the pandemic. Yeah. And then it was followed by a dip just as dramatic. So it kind of evens out, and we're getting around 1.5 at the end. But I think that it's hard. It's just incredibly hard to predict. There's a lot of factors. I tried to read a scholarly article on it last night, and it said that the labor market and economic situation plays a big part in household formation. But even then, just looking at the chart and how much volatility there is, it's incredibly hard to predict anything on, especially like a month-to-month basis. And sometimes it swings wildly from month to month. So it's incredibly hard to predict.
It really is.
Well,
just to kind of put a bookend on this report. So there's some, I guess, not some negative connotations of hey, we've got some concerns with household formation, but he also does say kind of at the end of this that the fundamentals for multifamily and renter demand are still very, very strong and more tailwinds rather than headwinds. He says their view of consumer sentiment will eventually tick back up sooner rather than later. And then some more tailwinds. The unemployment rate is incredibly low. Job growth continues to exceed expectations. Incomes continue to climb as well. And then the demographics. This is the long-term trend. Some of the long-term trends you were mentioning, Matt, is that there's not going to be a big valley in terms of going from millennial renters to Gen Z renters. He mentioned that going from baby boomers to Gen Xers, a lot less Gen Xers than baby boomers.
Yeah.
And then that occurred in the 90s when Gen Xers were renters. Just not enough people to fill up those apartments. There wasn't that driver of those people in that age demographic that are renting.
Yeah.
But even though millennials are a bigger demographic group than Gen Z, the Gen Z generation, it's not such a dramatic difference that there's going to be a huge drop off. And then more millennials are running for longer because of all we've talked about.
Yeah.
And so, again, the demographics are pointing us in the right direction.
One more thing, and you kind of
Yeah.
skimmed over it. He predicts, and he said at the end when he was talking about the demographics being good and everything like that, at the end of that sentence, he said demand could be somewhere between. No, it's a couple paragraphs up, almost hidden, and is almost tossed up. It's one paragraph above there, yeah, and it says rental demand in 2023 could be somewhere between 2021 and 2022 levels. That's great. That's kind of incredible. Because if you ask me, I'd think that it'd be a little bit below current levels.
Yeah, I would say it'd be between
continuing-
2019 and 2020, in 2020.
Now maybe that's a typo, but if that's the case, that means that the performance of 2023 will be better than 2022.
I think that's an interesting interpretation of how he's interpreting it, because that's the first I've heard. That flies a little bit in the face of kind of the moderation.
Mm-hmm.
And I mean, if I had to again do very lazy math, I think the demand that we've seen in 22 is basically half what we saw in 21. And I think we see half the demand again next year.
I think that's
it's like we had
continued trend, for sure.
16% growth in 21. We're going to get 8% this year, 4% next year.
Yeah.
Still higher than average, but very much moderating and normalizing. That's again lazy, and it's just demand's going to have to normal that, or we get a decline. But I don't. Again, with all these tailwinds, I don't see a major decline.
Yeah.
Just given where we are in the economy and in the market.
Completely agree.